The economy is finished. That's what many people are saying. And investors in these financial markets are finally realizing the scam that was told to us that we have a strong economy. Well, what is a strong economy? Well, the way we define it here in the United States and around most of the world is spending. So when people take on debt, when people take out mortgages, when people borrow against their home equity and go spend that money, that's looked at as economic growth or economic strength, and that boosts the GDP number. Well, what happens when debt gets to a level where it's unsustainable? Now, combine this unsustainable record debt that most people are in right now, now with rising prices and prices that don't seem to be slowing down or stopping, now we have the harsh reality that is people are running out of money. And the gauge that's used to measure economic growth is now being smashed. We see the savings rate in the US dipping now um, over a 5-year low. It's going to be a 10-year low here if it keeps dropping, and it's likely going to keep dropping unless some other rescue programs are implemented. Maybe a new round of stimulus checks, maybe another freeze on rents and foreclosures. We'll have to see what the second half of 2022 brings us. But yes, the economy as it's currently measured is finished. Now, does that mean the earth is going to stop? No, it just means that people are going to have to start buckling down, make different financial decisions. You're going to see spending drop in certain areas and certain categories. We know that consumer confidence now has dropped to over a 10-year low, and that's not all. Look what else has dropped to the lowest since 2001. The recent pain in the stock markets now have stocks on the biggest weekly losing streak since 2001. But it's been another brutal week and a half in the stock market. Now, the recent drop off in earnings with companies including even Target and Walmart have also markets panicked. And retailers are in a tough position now. Do they raise prices because of this higher overhead, these higher energy costs, or are consumers starting to balk at buying some of these items at the current price levels? Well, it's not just that, it's that consumers are running out of money. Savings is dropping. People are taking on more and more debt just to get by, not just for luxury items, but just for things that they need in everyday life. Your grocery bill, your car repairs, your insurance, your fuel, things that you have to pay, your taxes. So this is putting the consumer in a very tough position. So now the retailers have to decide, okay, do we start dropping prices so we can move more of these items? And there's a few reports out there saying that a lot of these retailers stocked up very heavily after the health crisis. And now that they have an oversupply of inventory because they panicked and they bought in mass quantities, and now they have an oversupply that they're looking to unload. So if that's true, it's pretty simple. We're going to have to look for falling prices pretty soon in retail. We don't know exactly what's happening with that story with the inventory. We know what a few reports are telling us, but we'll have to just see and look for the evidence. That evidence of a massive oversupply of inventory will be falling retail prices. Of course, we're going to keep an eye on it here for you. Now, with some items in the grocery aisle, we're definitely not seeing an oversupply. There's not a massive inventory sitting in a warehouse. For example, eggs. I think just a couple reports ago, we showed you the eggs in a Walmart here in San Diego, and they were about 85% empty. And we've documented pretty well what's been happening with the farms here in the U.S. So definitely still be cautious and think very carefully around how you're going to budget for your grocery bill, because we don't see grocery prices falling anytime soon. In fact, we think those particular products, food products, are going to continue to go higher. Now, the debt levels of the average US consumer, combined with the drop in the markets, have the wealth effect now really making people very, very cautious. So when people see their stock market portfolio elevated, when their 401k is rising, they feel more confident to go out and spend. But now you've got the double whammy. You've got the drop in savings and the drop in the markets, and people are starting to freak out in many cases. Also, initial jobless claims are on the upswing again. We see initial jobless claims now rise to about a 4-week high. And we expect another surge in jobless filings. And we'll see this huge uptick, I think, starting in the later part of the year. What could be starting now, but really going to be noticeable and I think even shocking what we're going to see in the later part of this year here in 2022. Now, rising prices combined with falling savings for U.S. consumers, falling markets combined on top of that, has people concerned now that the U.S. housing market has peaked. And there's a lot of articles out there, not just on social media, but mainstream news now saying that the housing market has peaked. Now, they're not saying that we're headed towards a 2008 type of collapse. Why is that? Well, they know that the banking system has completely transformed since 2008. If the Fed continues to pull support away from the housing market with the double whammy of rising rates and also the slowdown in the purchases of mortgage-backed securities, then you could see the housing market take a turn. Now, the wild card that I've been talking about here on this channel is institutional investors, big money coming in and scooping up so many homes that we really are not going to see any significant price corrections. I don't think anybody knows exactly how that's going to play out, but we're certainly going to keep an eye on it. But what the Atlantic is reporting here in this article is the rising inventory. So let's go ahead and take a look. Let's take a look at a Fed chart here of the inventory and see if it's really significant or not in the housing market. And if we look to the far right here, we see that we're definitely up compared to last year. This is a 1-year chart. We're currently at 6.4 months of inventory on the market. And even if we zoom out here to a 10-year chart, you can see to the far right here that we're zooming up close to the highs that we've witnessed over the past decade. So it could be a sign of things to come. In just about every recession and housing market downturn, we saw spiking inventory. Just look at the chart right here. We see 2008 financial crisis, spiking inventory. We saw what happened in the 80s where they had to drastically raise interest rates. And this is starting to get very, very interesting. So fasten your seatbelts, everybody. Continue to use caution out there in the markets and in your own personal finances. I'm not giving investment advice, just urging everyone to be careful, be diligent, keep stacking, and keep preparing for what's ahead of us. And I think we're all going to be really surprised the way the world's going to look here, and just probably by the end of the year, we're going to start seeing big, significant changes. And we're even talking about price controls now being implemented with gasoline. We're going to dive into that in our next report. So please make sure that you are subscribed and that you come back to this channel so you can stay ahead of the curve on what's happening. Thanks everybody for being here. Be well, stay safe. Bye now.